I hope you enjoy watching this video.
This is the video lecture for Chapter 2, Accounting 201, Accounting for Business Transactions. The highlighted learning objectives are the ones that I will review in this recorded lecture. The other learning objectives you can read about in the full PowerPoint in Blackboard. So first we will look at what an account is. An account is a record of the increases and decreases in a specific asset, liability, or equity account. Remember that equity is composed of revenues, expenses, common stock, and dividends. And the general ledger is a record of all of the accounts used by a company. So you will recall the accounting equation, assets equals liabilities plus equity. Here are examples of assets: cash, land, accounts receivable, supplies, equipment. Here are examples of liabilities. Any account with the word payable in it is a liability. Accounts payable are amounts we owe to our suppliers. And then we also have unearned revenues, which we will discuss. These are equity accounts. Common stock and revenues increase our equity. Dividends and expenses decrease equity. So here's the expanded accounting equation. Assets equals liabilities plus equity. Equity is composed of common stock, dividends, revenues, and expenses. So now we're going to look at a ledger and a chart of accounts. A ledger is the collection of all of the accounts for a particular company, and the chart of accounts is a listing of all the accounts along with an identifying number for each account. So you can see that the cash account is 101, revenues, consulting revenue is account number 403. So assets begin with a 1, liabilities begin with a number 2, equity begins with 3 and includes 4 and 6. We've skipped 5. 5 is for a special account that we'll talk about in Chapter 3 called Income Summary. So now we're going to look at what is a debit and what is a credit. Debit simply means the left side of an account. Credit means the right side. So it depends on the type of account whether a debit will increase or decrease that particular account. So this slide and the next slide, I recommend that you go to the full Chapter 2 PowerPoint and print these slides. So we have the accounting equation, and you can see that assets on the left-hand side are increased with a debit. This also means that a debit balance is the normal balance for an asset. Then you can see that on the right-hand side of the equation, we have liabilities and equity, which are both increased with a credit. So liabilities and equity have normal credit balances. Here's the expanded equation. So increases to equity include common stock and revenues. So they will be credited to increase and have a credit normal balance. And remember that dividends and expenses decrease equity, so they are increased with a debit, and they have normal debit balances. This shows how to compute the balance in an account. So this is the cash account. You would add up all of the debits add up all of the credits, subtract, and that is your balance. So we will look at recording transactions and posting them to the ledger. This shows the steps. So first you would identify the transaction and the source document. So we have a sales receipt, a purchase order, a bank statement. Then we will analyze it using the accounting equation. Then we will record the entry in the general journal. Then we will post it to the general ledger. So this shows how to record a transaction. We will list the date first, then the account to be debited, which is all the way over to the left, and the amount. And then you will indent and list the account title of the credit and list the amount under the credit column. And then we have an explanation. So this is a general ledger account for the cash account. You can see the account number here. And we have 3 columns for numbers, a debit, a credit, and a balance. So you would list the journal from the journal entry. We have a debit to cash and bring the balance forward. The next entry, credited cash, $2,500. So now to get the balance, we take $30,000 minus $2,500 to get $27,500, which brings our balance down to $1,500. And then on December 10th, we had a transaction that increased cash $4,200. So now the new balance is $1,500 plus $4,200, which comes to $5,700. This shows you the process of how to post. So here is the journal entry that we're posting. We have an amount to post to the cash account. So come down to the cash, 30,000 debit, 30,000 debit, bring the balance forward. Then we have to identify the credit account, which is common stock. So go to the general ledger and find common stock. And here we will credit common stock for 30,000 and also bring the balance forward. Now we will analyze the impact of transactions. So these are the same transactions that we looked at in Chapter 1. The first transaction was where the owner invested cash in exchange for common stock. And we recorded this in Chapter 1 in the accounting equation, which you can see here. So now what we're doing in this chapter is journalizing it. So debit cash to increase it, credit common stock to increase, and then post. Debit side of the cash account, credit side of common stock, which is equity. Second transaction, we paid for supplies with cash. This was the analysis from Chapter 1. We decreased cash and we increased supplies. These are both assets. The journal entry is debit supplies, credit cash, and then we will post. Increase supplies, $2,500, decrease cash, $2,500. Here we purchased equipment for cash, so debit equipment, credit cash. We're increasing equipment and we are decreasing the cash account. Here we purchase supplies on credit, so debit supplies to increase it, credit the liability, accounts payable also is increased because liabilities are increased with credits. So we're increasing supplies and we're increasing our liability, accounts payable. We provided services and received cash, so debit cash to increase it, credit consulting revenue also to increase it. Then in your cash account, increase it on the debit side, consulting revenue account, increase it on the credit side. We paid expenses in cash, so Remember, expenses are increased with a debit. So increase the expense, decrease the cash, and then post. Rent expense debit, 1,000, cash credit to reduce it, 1,000. Here we have payment of expenses in cash. So this is the same as number 6. Debit salaries expense, credit cash. We're increasing our expense. We are decreasing our asset. Provided consulting and rental services on credit. So we are debiting accounts receivable, which is an asset. So we increased that. We also increased our 2 revenue accounts. Here we received cash from our customer. So now we're debiting cash to increase it, and we're crediting accounts receivable to decrease it. These are both assets. So one asset went up, one asset went down. So now this customer no longer owes us. Here we made a partial payment on our account payable. So we are decreasing the liability accounts payable, 900, and we're decreasing cash, 900. So now you can see the decrease to accounts payable. The balance is 7,100 minus 900, and we're decreasing our cash. Here we pay dividends. So dividends is increased with a debit. Cash is decreased with a credit. Receipt of cash for future services. So a customer of Fast Forward paid $3,000 in advance of us providing services to that customer. So this is an unearned revenue. This means it's a liability. We owe for that. So we're increasing our cash account, but we're also increasing a liability. We need to provide $3,000 of services to this customer at some point in the future. Here we paid for insurance coverage. So this is prepaid insurance. We are prepaying 24 months of insurance. So we are debiting an asset called prepaid insurance, and we are decreasing an asset, cash. This $2,400 is prepaid, and it's an asset because it will last us for 24 months. We purchase supplies for cash, so debit the asset supplies, credit the asset cash. Payment of expense, they paid utilities expense, debit utilities expense to increase, credit cash to decrease. Transaction 16 is paying expenses in cash, so similar to the one we just looked at. We are debiting salaries expense, which increases it, and crediting cash, which decreases cash. This is a summary of all of the transactions, as you can see in T accounts in the general ledger. Now we're going to look at a trial balance. So a trial balance has 3 steps. First, we will list each account and the amount from the ledger. If an account has a 0 balance, we can list it with a 0 in the balance column, or we can omit it. Then we will compute the total of the debit balances and the total of the credit balances. And finally, we will verify or prove that total debits equals total credits. So here's the trial balance for Fast Forward. So notice that every account will be listed in the trial balance under the normal balance side. So cash has a ending balance of $42.75. accounts receivable did not have a balance, so we actually could have omitted that. But you can see these are all assets, so they all have normal debit balances. The liabilities, accounts payable and unearned revenue, are on the credit side along with common stock. Dividends has a normal debit balance. The 2 revenue accounts have normal credit balances, and then our 3 expenses have normal debit balances. So the reason we do the trial balance is to make sure that the total debits still equal the total credits. So within each individual journal entry, the debits and credits will equal. Then you post to the general ledger, and then this is to make sure that you have done everything correctly and the balances are correct prior to preparing the financial statements. So now we will look at preparing the financial statements from the trial balance. Remember that the balance sheet is prepared as of a point in time. So a snapshot on the day it's prepared. The statement of cash flows, statement of retained earnings, and the income statement are all prepared for a period of time. So we're looking at a period of time, a month or a year. You'll recall from chapter 1, the income statement reports revenues minus expenses. Statement of retained earnings reports changes in the retained earnings. We add our net income or subtract a net loss, and we also subtract dividends. The balance sheet will report as of the day it's prepared, the assets, liabilities, and equity, and then the statement of cash flows will show us how we went from our beginning cash balance to our ending cash balance. So here's our income statement. We had 2 revenues, which totaled $6,100. We had 3 expenses, which totaled $2,705. So our net income is the difference, which is $33.95. Then we have our statement of retained earnings. We begin with a 0 balance. We add our net income, subtract our dividends, and that gives us our ending retained earnings balance, $31.95. Then we can prepare the balance sheet. So we list the ending balances of all of our assets, get their total. We list the ending balance of all of our liabilities and get that subtotal. We include common stock and our ending retained earnings balance from December 31st from our statement of retained earnings. We add up our equity, then we add total liabilities plus equity to get total liabilities and equity, and these amounts should always be equal. Total assets equals liabilities plus equity. This concludes the recorded lecture for Chapter 2.
I hope you learned a lot watching this video.